Inflation holds steady in July. Good news, everyone! Inflation in the US remained stable in July, which is a welcome change from the rapid increases we've seen in recent months. This means prices didn't go up as much as they did before, giving consumers a bit of a breather. This is a positive sign for our economy, indicating that the measures taken to curb inflation might be starting to pay off. It shows that the efforts to control rising prices might be working, and this stability could lead to more predictable economic conditions. Remember, we all felt the pinch of higher prices last year. From groceries to gas, everything seemed to cost more. From groceries to gas, everything seemed to cost more, putting a strain on household budgets. A slowdown in inflation means we might see some relief, with prices stabilizing and possibly even decreasing in some areas. Of course, we're not out of the woods yet. There are still many economic challenges ahead, but this news gives us hope for a more stable economy, where we can plan our finances with a bit more confidence. Keep reading to understand what this means for you and how it might impact your daily life and future financial decisions. Section 2. Understanding the PCE Price Index. You might be wondering, how do we even measure inflation? One important way is through the PCE Price Index. PCE stands for Personal Consumption Expenditures. Think of it as a basket filled with all the things people usually buy: food, clothes, rent, and more. The PCE Price Index tracks how the prices of these items change over time. The Federal Reserve, which is like the central bank of the US, pays close attention to the PCE. They use it to make decisions about interest rates. We'll talk more about that in the next section. Section 3. The Fed's response to inflation trends. The Federal Reserve has a big job. It tries to keep our economy balanced. One way it does this is by adjusting interest rates. When inflation was high, the Fed raised interest rates to cool things down. Higher rates make it more expensive to borrow money. This can slow down spending and, hopefully, bring prices down. Now that inflation is stabilizing, the Fed might start to lower interest rates. Lower rates could encourage people to borrow and spend more, giving the economy a boost. But they have to be careful not to cause inflation to spike again. Section 4. Housing, services, and consumer spending. Let's break down how stable inflation is affecting different parts of the economy. Housing costs are still high, but they are rising at a slower pace. This is a good sign for anyone looking to buy or rent a home. Services like haircuts or car repairs are becoming a bit more expensive. This is partly because people are going out and spending more on experiences after the pandemic. Overall, consumer spending is holding up. People are still buying things, but they are being a bit more cautious. This is understandable with prices still being higher than usual. Section 5. Market reactions and future outlook. In this section, we will delve into how the financial markets are responding to the latest economic developments and what the future might hold. The financial markets are also reacting to this news about inflation. Investors and analysts are closely monitoring the situation, trying to gauge the long-term impact on various sectors. The stock market, where people buy and sell shares of companies, has generally responded positively. This optimism is driven by the belief that the economy is on a path to recovery. Investors are feeling more optimistic about the future. They are hopeful that the measures being taken will stabilize the economy and lead to sustained growth. However, it is still important to remember that the economy can be unpredictable. Market volatility remains a concern, and sudden changes can occur without warning. We are not out of the woods yet when it comes to inflation. The current economic environment is still fraught with challenges and uncertainties. Experts believe that inflation will likely continue to slow down in the coming months, but it is still above the Federal Reserve's target rate. This means that while progress is being made, there is still work to be done. But it is still above the Federal Reserve's target rate. The central bank is committed to bringing inflation under control, but it will take time and careful policy adjustments. The Federal Reserve will be watching the economy closely and will adjust its policies as needed. They are prepared to take action to ensure economic stability. They will likely continue to raise interest rates, but at a slower pace than before. This cautious approach aims to balance the need to control inflation with the goal of supporting economic growth. Section 6. What this means for your wallet. So, what does all of this mean for you and your finances? First, don't panic. It's crucial to stay calm and collected. Stable inflation is a good thing. It indicates that the economy is not experiencing rapid price increases. It means that prices are not rising as quickly as they were before, giving you more control over your budget. However, it is still important to be mindful of your spending. Keep track of where your money is going. Create a budget and stick to it. This will help you manage your finances more effectively. Look for ways to save money on everyday expenses. Small savings can add up over time. If you are carrying credit card debt, make it a priority to pay it down as quickly as possible. Reducing debt can free up more of your income. Interest rates are still relatively high, so it is important to get ahead of your debt before rates potentially rise again. Remember, knowledge is power. Stay proactive. Stay informed about economic developments and make smart financial decisions. You've got this. With the right approach, you can navigate these financial waters successfully.